Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jon Ferro, along with Lisa Abramowicz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.
David Rosenberg, president of Rosenberg Research, writing, quote, "There is nothing in the CPI report to get the Fed in a position to be cutting rates anytime soon." I'm pleased to say that David joined us now for more. David, great to catch up with you, sir. It's been too long. I just think you're perfectly positioned to run through this for us in detail. The pieces of this that will spill over to PCE, the bits that matter to the Fed, and ultimately the parts that won't.
Right. Well, look, I think that the bottom line is that the Fed does not target the CPI or the core CPI. It targets the PC deflator and the core PC deflator. And I think that one of the, more welcoming elements in yesterday's CPI data was the fact that medical care, goods and services were flat as a pancake. And that features much larger in the PC deflator. And I wouldn't be surprised when you re-weight the components of the CPI to the PC deflator, that the core ends up coming in closer to 0.3 or 0.2 than the 0.4 we saw in the core CPI. So my view was that yesterday's consumer price report is going to be a distant memory within the next 3 to 4 weeks. So I'm not as fussed about it as a lot of the other commentators you had on your show.
It seems like, David, that the markets agree with you. Are the markets responding appropriately to a report that you think is maybe a bit misleading?
Well, look, the stock market is really operating on a set of momentum and technical factors and not really, I don't think, paying attention much to what's happening in the economy. I mean, you have a stock market up 30% in the past year, thereabouts, and earnings are up 4%. So it's really been a multiple-driven market. The bond market sold off moderately, as you would have expected, on a higher than expected, especially core CPI print. But in the overall scheme of things, I mean, you have people on your show saying that, inflation is taking its time coming down. And inflation usually does that. It's like a race between watching grass grow and paint dry. It's not, inflation isn't Bitcoin or the CRB index or NVIDIA stock. It usually is glacial. But the bigger picture is this, when we strip out the shelter components of the CPI, which we all know are flawed in their treatment and they're lagged, headline inflation ex shelter is running at 1.8% year over year. It's already below target. This time last year, it was running at 5%. So I would just suggest let's move away from focusing exclusively on the monthly wiggles on the data and look at the bigger picture, because the broader trends in inflation and core are moving down, and I think moving down in a rather impressive fashion, notwithstanding yesterday's data point.
I guess what strikes me, David, is it seems like the balance of risks is perhaps a little bit more skewed to higher inflation after this report, especially because it doesn't seem like rates where they are now are particularly restrictive when it comes to capital markets and when it comes to risk asset valuations. So why should the Fed go ahead with cutting rates at a time where it doesn't seem like their higher rates are really affecting the economy or markets? And it seems like there still are questions around inflation.
Well, there's no doubt that financial conditions have eased rather dramatically in the course of the past few months. But I don't think that's why the economy did as well as it did last year and into the fourth quarter. It was really a lot of fiscal juice. It wasn't really about financial conditions. You got a rapid decline in the equity cost of capital. High yield spreads are super tight, but where's the CapEx boom coming out of that? We're not really seeing it. Last year's story, I mean, 2/3 of the growth in the economy last year came from the direct and indirect impact of fiscal stimulus, which frankly I wasn't expecting. I don't know if you were expecting it. I wasn't expecting that the deficit was going to expand 25% last year in the context of a sub 4% unemployment rate. That's never happened before.
So true.
So a lot of the growth was really fiscal. Financial conditions have eased, but I'm not really seeing any dramatic impulse on economic activity from that easing in financial conditions. And the one thing I'm going to point out is, the Fed is telling us increasingly that it is, shifting its focus from the month-to-month gyrations in the data, of course, that grab the headlines until the next month's data come out. And they're focused on what business contacts are telling them. And quite frankly, when you look at the swath of comments coming out of the Beige Book, the latest Beige Book out of the Fed, what did it say? It said that businesses found it harder to pass through higher costs to their consumers, who became increasingly sensitive to price changes. So that's what's happening in the real world. And in the CPI world, we have over 40% of the items in that index are imputed guesswork by BLS statisticians as it pertains to services. So when you look at the real world, what did the Walmart CFO tell us a couple of weeks ago about pricing trends at Walmart, the world's largest retailer, is that their pricing momentum is actually dissipating. So I'm not getting too fussed by one monthly CPI number, that's for sure.
David, I've got about 45 seconds left with you. I wanted to squeeze this in. There's a phrase I see a lot from research at the moment, and it's not 1999. And I just wonder, from your perspective, what is the value of benchmarking to such an extreme time in the equity market? Is there any value in that at all?
No, I don't think that it's useful to compare it to today's world to any other world any more than in 07, people comparing it to previous cycles. Every cycle has its unique characteristics. Every cycle has its similar patterns. No, I'm not saying this is like 1999 or the dot-com bubble, because most of those companies didn't have a business model and didn't have earnings. However, we do have a situation where the forward multiple now in the S&P is 21. And it is in the top 10%, the top decile of valuations in history. So it doesn't detract. I mean, people like to say it's not 1999. Well, go knock yourself out on that comparison. But whether you're taking a look at corporate credit, you're taking a look at the equity market, it's a nosebleed territory in terms of valuations. And so that's where I come out of it. That is still a very expensive set of circumstances in across most asset classes.
David, we're going to continue this conversation.
It's not as dire as it was in 99, but it's
another
still
time.
A constraint.
David Rosenberg of Rosenberg Research. David, appreciate it, sir. Former New York Fed President Bill Dudley warning the next goal is reducing QT, writing this in Bloomberg Opinion. A final plan should be in place by the middle of the year. Whatever happens, the destination matters a lot more than the speed. I'm pleased to say that Bill Dudley joined us now for more. Bill, let's talk about this. What kind of considerations go into making a decision like this one?
They want to behave in a way that does not risk causing turbulence in financial markets. So the reason to do the taper is you're not really sure what the desired level of reserves is in the banking system. So you want to approach the runway very, very shallowly rather than steeply, especially when you don't know where that runway exactly is. So I think the taper is a prudent course of action. It doesn't really matter if you get to the desired level of reserves in 2 years versus 1 year. It's just the fact that you get there. So I think that they're going to discuss it at the March meeting. That was made clear by Powell's last press conference and in the FOMC minutes. And then they'll talk about the staff's proposal. And I think we'll see a final plan by mid-year.
Bill, you've said the central bank needs to shrink the balance sheet enough to rebuild the stimulus arsenal. I just want to get into that a little bit more. I've said this to you before. I feel like this is some kind of Jedi mind trick at the Federal Reserve. They want you to simultaneously believe that QE stimulates and QT does nothing. Bill, what does QT actually do?
Well, QT does withdraw restraint that they've put into the system previously, but economists who have looked at QE versus QT find big effects when there's QE announcements, very little effects when there's QT announcements. And the reason is sort of obvious. You don't ever know when a QE program is going to be implemented. The economy has to be really falling apart. Interest rates have to be at the zero lower bound. So QE is usually a surprise. QT, though, once you've done QE, you know QT is going to fall at some point, that the Fed's going to ultimately unwind the QE that they did earlier. So when QT happens, it's really a question of timing and magnitude, duration, not whether it's going to happen or not. So it has pretty much more milder effects.
There's also a Jedi mind trick going on, Bill, when it comes to financial, just in general conditions. The fact that we've seen dramatic easing in financial conditions, and that doesn't seem to be weighing on the Fed in terms of how that affects their ability to get to 2%. But when you saw a sell-off, that was concerning and some sort of restriction. Does that concern you that the easing in financial conditions doesn't seem to be anywhere on the radar of Fed officials?
Well, I think it's in the radar in the sense that the reason why financial conditions have eased is because people expect the Fed to cut rates this year. But the Fed actually has to cut those rates to keep financial conditions where they are today. I think at this point, we know that March is off the table. May is probably off the table, too. We're really talking about Fed cutting rates probably sometime this summer. The focus at the meeting, as I said, is going to be, Paul's going to get a lot of questions about the QT taper since people know that's on the table. But the other thing that's going to get a lot of attention is the summary of economic projections and how many rate cuts do Fed officials pencil in their forecast. Last time, the median was 3. I would guess the median will be 3 again this time, but there's some possibility, given the firmness in the inflation data, that maybe those are only going to be, the median's going to shrink to 2. But I bet they keep where they were last time. There's still plenty of time, still plenty of meetings this year to cut rates 3 times.
But this goes back to the question that we've been asking all morning. Has the balance of risks, arguably on a minor way, shifted just a bit after the CPI print to the fact that maybe it makes sense for them to hold rates higher for a bit longer because it doesn't seem like it's dampening some of the economic activity or materially harming the U.S. economy?
I think it has, but I think that's been their strategy all along. The market got way ahead of the Fed earlier this year when the market was pricing in 6 to 7 rate cuts this year, and the Fed was saying, no, we're going to do quite a bit less than that for the very reason that you said, that the Fed wants to be sure that they're actually be successful in getting inflation all the way down to 2%. And the not so good inflation prints that we saw recently, just reinforce that. So I think the world is sort of going the way the Fed Reserve was expecting rather than the way markets were expecting. And I think that I think there's plenty of time to see how the balance between growth and inflation plays out. But, as you know, these are balancing acts now. The Fed is focused on both sides of its dual mandate, not just inflation, but also what's happening to the economy. And while the economy has held up quite well, there are signs that it is slowing. And so the Fed is trying to get the balance right between these two risks.
Bill, this is the total opposite of the conversation we had post-GFC. I was talking about this a little bit earlier in the programme. I want to do it again with you. I think it's important. Coming out of the great financial crisis, 07, 08, 09, we always had these charts that came out, and it was basically Wall Street looking for liftoff at the Federal Reserve. And then you had Fed funds just doing nothing for years. And every single year was liftoff. Liftoff's coming. It was false dawn, false dawn, false dawn. Are we looking at a situation that could be the total reverse of that, where we have again and again just a false dawn looking for cuts that never come because this expansion just looks so much better than people thought it would be?
Well, that really depends on how tight monetary policy is, and that's one thing we don't really know. Every time the economy turns out to be stronger than expected, people start to talk about, well, maybe monetary policy is not as restricted as we thought. This is coming back to the discussion of R-star, the neutral federal funds rate. One other thing that's going to be interesting in the upcoming meeting is whether Fed officials raise their estimate of what a neutral monetary policy looks like. If you look at the current projections, they think that at 2% inflation, the federal funds rate to be neutral should be 2.5%. And it's very possible, given the strength of the economy that we've seen over the last year, that they're going to start to push up those estimates.
Well, that's exactly where I wanted to go. Katie Kaminsky earlier was saying there's a real signal from the fact that financial conditions have eased so much in the face of rates that have remained so high. Do you take that signal? Do you think that the Fed should be lifting their R-star rate, their neutral rate expectations?
Yes, I do. I think there's lots of reason to think that R-star is higher than it was in the recent past. Fiscal policy has been very expansive. The government has put in place a number of new investment programs, CHIPS Act, infrastructure spending, climate finance. So all those things are increasing investment relative to a diminished savings pool that we should raise R-star over the longer run. I also think that financial conditions are the right way to think about monetary policy. And so to your point, if financial conditions are easier, then there's less easing for the Fed to do.
Bill, just a final question from me. You've alluded to this, but just to speak a little bit more clearly on the topic, how uncomfortable should they be, will they be, with yesterday's CPI print?
I don't think the Fed takes a lot of signal from one or two inflation prints after a series of very good inflation prints. But I think, the fact that it's now 2 rather than 1 it's now on their radar screen.
Bill Dudley of Bloomberg Opinion. Bill, appreciate it. Thank you, sir. FCC Commissioner Brendan Carr joins us now for more. Commissioner, been looking forward to this conversation. I've got your comments in front of me on TikTok. You've called it before a clear and present danger to national security. I'm sure TikTok would disagree with that characterisation as well. Can you give us some concrete examples, sir, of why you think that's the case?
Yeah, the track record with TikTok's malign conduct is very clear at this point. For years, they told U.S. lawmakers, don't worry, U.S. user data isn't even existing inside China. And then a blockbuster report came out in 2022 that showed no, in fact, quote, everything is seen inside of China based on leaked materials. That's keystroke patterns, biometrics, search and browsing history, location. Then second of all, what the CCP are doing with that data is very nefarious. They use access to that data, personnel in Beijing did, to surveil the locations of specific Americans, journalists, that were writing negative stories about TikTok. Third, TikTok said, okay, you caught us red-handed. We're going to wall off U.S. user data. But lo and behold, the Wall Street Journal report came out and found that personnel in Beijing are still getting access to that data, sensitive U.S. user data, after agreeing to wall it off. And the record goes on from there, including TikTok's parent, ByteDance, having a CCP cell embedded in its leadership. So this is about the malign conduct that an entity that is beholden to the CCP has been engaged in.
When you talk about walling off that data, you're talking about Project Texas. Has it not worked at all?
No, not at all. So one of the leaked materials had TikTok trust and safety officials themselves saying that it remains to be seen whether product and engineering, meaning Beijing, can still get access to U.S. user data after mitigations like Project Texas are put in place. Second of all, that walling off of data that we just talked about was part of Project Texas. And again, Beijing still got access to it. And even TikTok's CEO has said Project Texas will keep data from going to Beijing except when we allow it pursuant to what they claim are new controls. So Project Texas is about as secure as a sieve at the end of the day.
In a day of interesting and odd political bedfellows, what we saw yesterday in Capitol Hill is a lot of individuals come out and talk about free speech on the progressive left and the right. Ron Paul saying he's going to block anything that's contrary to the Constitution. Do you agree? Is there a free speech issue at play here?
You know, look, Rand Paul's been great on these liberty issues. This particular bill does not trigger a First Amendment concern for one main reason. The Supreme Court has drawn a clear line between regulations based on content of speech on the one hand and regulation of conduct on the other. And this plainly is a conduct law, meaning we're acting because of the demonstrated malign national security threat of TikTok, not because of the content of anybody's speech. And the bill is narrowly tailored, which is key for First Amendment analysis, because it simply requires divestment, meaning the millions of Americans that love TikTok, I'm not one of them, but they can continue to use the application, but just in a more secure way. So because of the conduct at issue here, the Constitution does not compel us to require a national security threat to continue to persist.
Well, there's one politician in D.C. who certainly likes TikTok, and that's President Biden. In the sense of his campaign, they feel like they're able to reach the youth by using TikTok. So if TikTok is divested, there's a sale, would that mean that the Biden campaign can continue using it, but do you think it'll be safer?
Yeah, that's right. You know, a lot of people raise that concern about the Biden administration being on TikTok, but Biden administration officials have been very clear that there's a national security threat here. That's why passing this bill actually squares the circle, because then the campaign or anybody's campaign could continue or start to be on TikTok, but without that serious national security risk that's present today.
Commissioner, given the fact that we've heard that from President Biden, I'm curious about your comments from the former President Trump, who seems to be, I don't know, less clear about what he thinks of this bill, saying, you know, that there's a lot of good, there's a lot of bad with TikTok, talking about how it increases the prevalence of Meta. What do you make of his comments?
Yeah, I think, first of all, President Trump, you know, fundamentally reshaped Washington, D.C. to understand the serious threat posed by the CCP. He's also raised concerns, as I have, with the conduct of big tech companies that are based right here in Silicon Valley. And those are real concerns. He pushed for Section 230 reform, which I supported and had hoped we would have gotten across the finish line at the FCC by now, and we haven't. But TikTok presents obviously sort of a threat that's fundamentally different than U.S. big tech companies. For all of my concerns with their conduct, and I have many, once we deal with the national security threat from TikTok, once you break that tie back to the CCP, then we should move very quickly, as President Trump has outlined, on Section 230 reform, and in my view, affirmative anti-discrimination obligation that would apply across the board. But until you break that link to the CCP, a lot of other reforms just aren't going to work out.
But it does feel like he flip-flopped on this in the sense that he wanted to ban it under his administration. It then got held up in court. And now he's saying he's really not so sure about it. Do you think we could see a different, if he was to become president of the United States, a different view on TikTok because of his concerns of how big Meta is?
Well, again, I think the reason why this bill is such a smart approach is because it's not a ban bill, it's a divestment. And so you would have TikTok go to a different, doesn't even need to be a U.S. company. It could be any company that's not tied to China, Russia, North Korea, or Iran. So you can continue to have TikTok in the marketplace as a counterweight to Facebook, as a counterweight to others, but it can be there in a way that doesn't present the national security threat. So it keeps that competition high.
Commissioner, we seem to be ill-equipped to deal with these issues. It's been about 4 years since we've been talking about this, and hardly anything has happened just in terms of actually passing proper policy to do something about these national security concerns. I think back to China. It's easy, it's straightforward. She comes out and says no, and then that's it. It's banned, it's all banned. Twitter, Facebook, YouTube, no access. Why are we so ill-equipped in the West to deal with these threats, and how do we go about changing that?
Yeah, we certainly have a very different system, obviously, than they do in China. And some people raise concerns about, will China engage in some sort of reciprocal action based on that? And I remind people, Facebook and other U.S. technology companies are already banned in China. So yes, we move more slowly. We move in a much more considered way. And obviously don't underestimate the fact that, ByteDance has put every single amount of lobbyist dollar possible to slow roll this. And people look at the 118th Congress and they say, they have a hard time getting things done as a general matter. But this is one where the 118th and Speaker Johnson can land a significant legislative win, not just on a tough issue, but as you know, on a technology issue where it's sometimes difficult for Congress to act. And that's why the Commerce Committee with Chair Rogers holding that blockbuster hearing last March, I think that really set things in motion. Do people wish it would have gone faster? Sure, undoubtedly. But arriving here today where there's a vote in the House is a significant moment.
Significant moment in the House, but what happens next in the Senate, Commissioner?
Yeah, I feel pretty good about the odds in the Senate as well. If you look back, actually, people sort of have forgotten this, but Senator Schumer joined in a letter with Senator Cotton back in 2019, raising serious concerns about TikTok's national security threat. So this is an issue that is a long-standing issue for Senator Schumer over there and many, many Republicans as well. So a lot of the focus has been in the House, obviously up to now. It'll now shift to the Senate. But I think the odds are very good there as well. And I'm looking forward, hopefully, to the bill passing today in the House and then things moving over there.
Commissioner, I want to finish on conduct versus content. You talked about this being a conduct issue. Do you believe there is a content issue in any way, shape or form as well?
No, not at all. I mean, look, sometimes we focus on the way the algorithm with TikTok performs, and people have focused on that, how it just shows content that is drastically different than any other social media, content that happens to align with the CCP. Again, it's not that content that's the concern for me. It's that content shows that there's such a drastically different operation of the algorithm that it goes fundamentally to conduct into CCP control. So when we talk about that, again, it's just further evidence of CCP control. It's not about the government acting based on content. Again, I'll give you one last analogy. Someone can take a pen and they can write the most salacious anti-American propaganda they want. There's nothing, rightfully, the government can do. But if you take that pen and you use it to pick a lock and break into a building, well, that's illegal conduct. We can take the pen, and it's no defense for you to say that you were using it to write previously.
Commissioner, appreciate your view this morning, sir. Thank you for joining us. We'll catch up soon. FCC Commissioner Brendan Carr.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.